So my topic is about tactical versus strategic U.S. equity allocation. And what we're really trying to answer with this session today is, can we add additional value to your U.S. equity portfolios by moving in and out of U.S. equities based upon certain data readings? We're going to look at two different sets of data. We're going to look at PE ratio and dividend yield. I think a fair question to ask already is, well, why those two? And quite frankly, they're in the news the most. They have the most available, longest dated data series available to analyze to make some conclusions about this. Now, let's just kind of look at and see how these data series have moved over time. What you'll see is a moving blue line, which moves all over the place. It moves up rather quickly. And then what we're going to put up here, too, is the average of that data series and some standard deviations. Now, standard deviation is a math term. I know a lot of people in this room don't like math. I'm an actuary by training. I do my best to stay away from math conversations, but I hate to tell you, we're going to have a little bit of math conversation around today's discussion. We're going to use standard deviation as a measure of how inflated or deflated market prices look relative to averages. So the higher the standard deviation or the lower the standard deviation, the more higher priced or lower priced the market appears. Now let's just look and see how the S&P 500 has moved over the same time period. If you look at this chart, there's no real discernible pattern in relationship between S&P 500 movement in the PE ratio, okay? But what we're really interested in, we're not interested in all time periods. We're really interested in those times when the PE ratio is either really high or really low. And the hypothesis we're trying to answer is when PE ratio is really high, that usually means that the market's been on a nice run. So to that point in time, you've had a nice return from your portfolio from US equities. Well, is a correction around the corner? Does it make sense to rebalance, or if we want to be really radical about it, bail out of US equities, figuring that a correction's around the corner? And then conversely, if P ratio is really low, that means returns have probably been pretty disappointing. Is it an attractive entry point to plow into US equities and enjoy the market upswing? So that's what we're going to try to answer. We're going to look at it from a PE ratio, and then we also did it for dividend yield. Now, in the interest of time, and you not wanting to take the closest fork on your table and stab yourself in the eye because we're talking about too many graphs and math, we're really just going to talk about the results from PE ratio. Rest assured, the recommendations we make based on PE ratio mirror those what you would find from dividend yield. The first question is, well, how volatile is PE ratio? Because if it's a metric that doesn't move around a lot, well, then it's going to be impossible to really determine when you're in an outlier environment in terms of really highly priced equities or really low-priced equities. Now, keep in mind, we're using standard deviation as a measure of how far from that average price we are. The larger the standard deviation, the further you are from the average price, hence you're more overpriced or underpriced. Well, if we look at readings of PE ratio, which is just within 1/2 of a standard deviation of the average, so in other words, not too materially overpriced or underpriced, well, that happens almost 60% of the time. That's almost a normal market environment. We're less interested in those time periods. But as we move further along here for standard deviations of 1, and then particularly 1.5, then that's when things start to get interesting. In the second half of this talk, we'll spend some more time talking about the distribution of returns for those 1.5 times above or below the average. And then finally, 2 standard deviations above and below. So is everyone clear what we're going to try to do here? We're going to look at different readings of that PE ratio. The further it is away from the average, we think, at least our hypothesis, is that we're going to be able to discern more information about market direction. You see a similar distribution for dividend yield. Again, the findings are going to be the same across the two. Let's try to address this hypothesis. When markets have been on a nice run, what have the subsequent returns looked like? Now, we're going to look this year on a 1-year basis and a 5-year basis. I think as institutional investors, the focus should be more towards that 5-year period. We're concerned with long-term returns. We already heard Brian Singer's comments about focusing on that 5 to 10-year period, the 10-year returns rather than those shorter time periods, which can be driven by a lot of different factors. However, the title of this session is Tactical versus Strategic Asset Allocation. And if we're making a lot of moves to our portfolio based upon short-term data readings, well, I think the expectation is that you have to add more value to your portfolio over a shorter time period, hence the 1-year as well as the 5-year. So let's look and see how these readings come out. What we have here for the 1-year basis, if you move left to right in this graph, so blue is only slightly expensive, gray is really expensive relative to long-term averages. I don't think it's surprising that as you get more expensive in the market, your subsequent 1-year return is more and more disappointing. Critically, compare this to all 1-year time period returns in the S&P 500, 13%. Huge discrepancy. So maybe we're onto something here on a 1-year basis. What about the 5-year? Same exact pattern. The more expensive you are, the more disappointing the returns tend to be in this following 5-year period. Then your annualized 5-year return, 11.5%. Okay, well, high PE ratios tend to be followed by disappointing returns. Dividend yield tells the same story. Now, what about when PE ratios are below average? Is there attractive buying opportunities there? Well, I've already given away the result because everyone loves a bargain, as the title suggests. Here are your returns. Half a standard deviation, 1, 1.5, and 2, okay? So kind of no matter what measure you are in terms of cost relative to averages, when the market appears cheap, your returns trump the average by quite a bit. All those returns approach 20%. How about the 5-year? Same trend. So we're done, right? We have our conclusions. There's dividend yield, same pattern. What can we take away? Well, higher PE ratios, which suggest an overpriced market, have been preceded by largely positive returns in the market, are followed by below average returns, something called reversion to the mean, okay? I think everyone is familiar with that term. Lower dividend yields, again, another indicator that perhaps the market is overpriced. What happens? Below average returns. Well, you guys can draw on the rest of these with your own pens and pencils. Lower PE ratios, when the market's cheap, above average returns. Same story on dividend yield. So we're onto something, right? These directional returns appear consistent, and we're more and more interested in those outlier events. So the 1.5 standard deviation above or below for PE ratio, and then those 1 standard deviations from the average for dividend yield. Those extreme events tend to have a little bit more consistency, we think. 2 questions. How repeatable are these trends? If we're going to be tactical, well, we need to be right far more often than we're wrong, because just being right roughly half the time, you still come out on the losing end of things, because every time you make a trade in your portfolio, moving in or out of US equities, not only are you hopefully getting that call right, but you're also incurring transaction costs. There are trading costs. There are days of sitting out of the market sometimes when you're transitioning out of a position. Those are a drag on returns. So we need to make sure we can get this consistently right to make sure that you as clients can add additional value to your portfolio, and we as your investment consultant don't get fired, and the director of research who's giving that result to the consultants especially doesn't get fired. So are these trends a basis for tactical decisions? We've left something out of the conversation so far. It's kind of the fun of putting these together. You get someone going one way, and then you bait and switch and go a different direction. We need to build in volatility. That is a key consideration. It's kind of like talking about just return when you're building a portfolio, ignoring the risk component of it. They go hand in hand. They have to be in the same conversation. What we've done here is we looked at the distribution of returns following an environment when the market is really overpriced. First, here are your annualized 5-year returns. I don't think it's really surprising that the majority of your returns are in that 0 to -5 bucket. Not surprising because you've been on a pretty good market run. Perhaps a little bit surprising is off to the right, where you have some 20 to 25 and 15 to 20% annualized 5-year returns. So that's a 5-year series of returns that average out to that. Fairly clustered together, not too much dispersion. The volatility here is simply upside volatility. Most investors will take that. But now let's look at that subsequent 1-year return, where we're really trying to be smart and add value for the following 1-year basis. So probably not surprising, you're down here -25 to -30. Well, that's going to happen after the market's been really overpriced. But then you're leaving a lot on the table over here for upside. And that makes it really difficult to go in with 100% confidence to tell clients, balance out of US equities, sell out of US equities, tilt your portfolio radically away from US equities, okay? We're talking tactical here, so the idea is to add value in the shorter time period. Well, you've left a lot of money on the table in that instance right there. We add the averages in here. The majority of returns are below the long-term averages, but the key point here is there's a lot of volatility. If we look at dividend yields, it's the same pattern. Now flip this to when markets are really underpriced. You're going to see the same pattern play out time and time again here. We don't need to do as much detail on each one of these slides. Here's your 5-year. That's actually a fairly concentrated set of results. But here's your 1-year. And this is really difficult because this is now when the market's been really underpriced, the call would be to go in heavily into US equities. Well, that works out the majority of the time. You can get north of 60% in a year, but you can lose 15% in a year too. That's a spread of almost 80% between the negative results and the positive results. That's just simply unacceptable volatility, and I think it's a pretty safe way to conclude that tactical decisions based upon either PE ratio or dividend yield, not a viable way to consistently add value to portfolios. Quite simply, using PE ratio or dividend yield is not enough for tactical decisions. There's one more element of this talk today, though, and it really addresses where we are in today's environment. We were getting the question a lot back in early 2015, and then more recently after the August sell-off of, well, gee, PE ratios are an all-time high. The S&P 500 seems to hit a new high every month. Should we sell out of U.S. equities? Should we make tactical decisions around that? And quite truthfully, if we look at PE ratio or dividend yield, they fall within that 1/2 standard deviation above or below the averages. So a relatively benign environment for those factors. But there's some other kind of more macro overlays here to consider. Number one, the expectation is that global growth will continue to be slow. Number two, future capital market returns are dropping. We're going to have a slide up here in a few minutes that talks about the evolution of our projected returns based on our software, and they have all dropped considerably over the last 5 years. And then last, there's a lot of volatility. So a lot of asset classes are expected to continue to be volatile. Returns are dropping across asset classes, so it makes it more and more difficult to tactically allocate from one asset class to another if the return expectations are low for all of them. I'm going to quickly click through the distribution of returns based on PE ratio and dividend yield for kind of this benign environment we're in. There's not a lot to say. All I want you to look at is just the distribution of returns. The blue bars are all over the place. It reinforces the idea that trying to make recommendations, especially in today's environment on these factors, is a loser's game. You just have no way of knowing where you're going to end up. There's a huge spread between the end results. So this is for a marginally expensive stock market. So there's your 5-year, there's your 1 year, and there's your average. Here's PE ratio marginally cheap, and then we're gonna look at dividend yield as well. So same old story, okay? So I think we've reached conclusions more or less on trying to use these metrics to make tactical decisions. One last slide we want to show you is the evolution of our expected returns for capital markets over the last 5 years and how they have dropped, in some cases fairly significantly. We're going to show you bonds, we're going to show you U.S. equity, we'll show you international equity. Now, bonds have gone from about 4.8 to 2.1, so they've been split by more than 50%. U.S. equities, 9.3 to 7.2. International equity is 11.6 to 7.8. The key point here, though, is that we've already determined that being tactical based on data metrics is difficult to do. Then on top of that, with falling expectations for asset class returns, it makes it even more difficult because there's no real outlier opportunity there in terms of future market returns. So let's wrap up. You've seen there's some very clear limitations of valuation data. Directionally, for these extreme outlier events, they can guide the rebalancing decision, but we don't think it's much more than the rebalancing decision. Critically, the volatility is real. You've seen that by all the distribution of blue bars and red bars. It's most useful in times of extreme market movements, so those 1.5 standard deviation events, the 2 standard deviation events, when we're really overpriced, really underpriced. Again, we think it can guide rebalancing, but it's certainly not enough to make tactical decisions. Last but not least, we need to balance the strategic versus tactical elements of a portfolio and what we've talked about today. The tactical items we've talked about today, we think can be useful in terms of rebalancing within the context of your long-term investment policy statement, your strategic asset allocation, but trying to do anything more with your asset allocation based upon these tactical moves is going to be a loser's game, and it's not a grounds by which to run a portfolio.